Welcome to the Profit Strategies Weekly Podcast. Now, here's your host, Tom Gentile.
Hey everybody, Tom Gentile. I want to welcome you to today's Profit Strategies Podcast for week ending November 13th, 2020. Glad to have you all back once again. With me is Mr. Chris Johnson.
Hey,
CRJ
Tom.
Publishing. How you doing, Chris?
Doing great. What a week for the market. Fun stuff.
Yeah, what are we going to talk about today? There's absolutely nothing to talk about.
Not a bit. You want to talk about dogs, cars, how's the weather down there, Tom?
Well, we had a hurricane pass through.
Yeah, that was a loaded question.
Hurricane to tropical storm to not much of anything, but a lot of wet and a lot of wind.
Yeah.
So, it's weird because I've never seen a storm like this coming into the middle of November. It just, I've never seen this happen. And so it definitely is something new to me, being a Floridian for 15 years now? And I haven't seen this happen. Not this late. I
understand it. This is the first time they've gone through the entire alphabet. Is that correct? On naming storms. Yeah.
Yeah, we've alphabeted and then some. And then I also saw another storm that's out in the Atlantic, but it looks like it's heading toward jolly old England.
Oh.
So anyway, we do have a lot to cover today. So let's break it down. We're going to talk about the stock market, what it did this week. We're going to jump into some stocks. And I know, Chris, you want to get into the clean energy stocks again. And then I want to talk about my safety picks heading into the end of the year and beyond. So let's start stock market. Chris, what's notable this week about the overall market in your opinion?
Well, obviously, you have to start off talking about Pfizer on Monday morning. They kind of had a scratch the record moment, if you will, when they announced that they had a vaccine with 90% efficacy. I mean, it is now the front runner. And Pfizer's kind of been that quiet horse in the race, hasn't it, Tom?
It has. And the other big notable thing was it was a classic pop and drop on Monday. I mean, the markets melted up and they were, it looked like a Biden bump in the morning, but then after 7 o'clock, it became a Pfizer jump and everything opened higher. Even pre-market was higher than 9:30. And then we dropped. So anybody that jumped in and bought their positions at 9:30 was scratching their heads, getting a little buyer's remorse by the end of Monday. And, we've got some recovery since then, but still, you look at the overall market like the S&P. Monday was the heyday, and we're now trying to claw back.
Yeah, what stood out to me on this one, and it was another Moderna moment. Let's call them. You had Moderna back in May and then July again that had their kind of scratch the record moments where they came out and said, "Hey, look at us, we're moving forward." Market went nuts. Moderna stocks went through the roof and then filled the gap, slid right back down and came back not to normal levels, but it's always kind of etched its way up, kind of ratcheted higher. The market, when you look at those situations, continues. It's got a little more fuel in the tank because of these announcements. Moderna comes back down, and Pfizer's doing the exact same thing. It's at $38. It traded up to $42 on Monday morning. So I think this is just another Moderna moment. We've got, as I've been putting it, we've got another 2 or 3 innings in this ball game to go before the pandemic's gone, right?
Yeah, absolutely. And I want to also mention, let's talk about technicals for a minute with the overall markets. Yep. So there's one thing, it's hard to do technicals on an audio podcast, Chris, because that makes people, all of a sudden their eyes move up and maybe to the left or the right because they're trying to visualize the stock. But I want you to think about this, everyone. The S&P was down to 222 and change back on March 13th. And then, just on Monday, we were hitting highs in the 360s. So, I mean, we're talking about a better than 50% move off the bottom earlier in March. Now, sometime around, we'll call it Labor Day, we had a substantial pullback in the overall markets. And I was talking about Fibonacci retracements at that time. Chris, do you know we're at the 100% number again? 100% from the bottom to the top. If you take out Monday's pop and drop, because I only look at closing numbers. Those are the most important to me. I don't look at those stabs. But we're at the 100% high side right now, which means that, in a contested election, in a pandemic where Texas this week was the first state to cross 1 million cases of coronavirus, the market is still moving higher.
This market has got, you know what? I'll use that old phrase that it's been a while. I'll dust it off. It continues to climb a wall of worry. That is the best way to put this market. Every time something gets thrown in front of it, whether it's the pandemic, and now it's rising cases in the pandemic, it's contested elections. Now, granted, we expected a contested election, right? I think we all sat 2 or 3 weeks away and said, yep, this is going to happen. So
absolutely,
the market operates on expectations. It was an expectation. If it had gone, let's look at it from another view. Let's say you and I sat down with our hot cocoa or maybe bourbon at 10 o'clock on Tuesday last week, and they came out and said, oh, it's a landslide. It's completely done. Trump had conceded and said, I'm out. This is it. We'd be in a different position right now because that would be throwing the market a curveball. It didn't price that in. It's priced in a contested election. So this market just continues to climb that wall of worry. Love it.
And I sit here and I try to figure out, my biggest 3 words I've been saying to myself as I'm placing trades is margin of safety is what I say to myself as I'm adding to positions, et cetera. And we're going to talk about safety on the back part of the program. But I'm looking at the markets and I say, all right, yeah, the overall stock market, SPY, is hitting highs right now. But then you go look at the Amazons of the world. Okay, Amazon is, as of just even yesterday, we pulled back a good 25% from the highs that occurred back on Labor Day weekend. Yep. And then you take a look at Apple. Just announced the iPhone 5. In fact, they're now you can pre-order the iPhone. I keep calling it the iPhone 5, because I'm thinking 5G. It's the iPhone 12. Right. The 12 Pro I have in my hand. But apparently everybody was waiting for the 12 Pro Max, which is now you have the ability to pre-order. And if you happen to be one of the lucky people standing in line since Thursday at the Apple Store, you might have your hands on one of them. But Apple, even just a couple weeks ago, was a 30% retracement from the lows back in March to the highs that occurred, guess when? Right after the stock split. So it's not anywhere near its all-time highs yet.
Yeah, you know what? That stock split, we talked about this a few weeks ago, Tom. That stock split was just one of those things that everybody got all frothy about. Everybody was excited about Apple splitting. And I think you had so many people crawling out of the woodwork to buy the stock before the split because the simple perspective of that from most people that don't understand the simple fact that it doesn't create wealth, the split doesn't. It just brings the price down. People got into it and they just had to run in barn burners. And I think we're still working off some of that froth. When I bring up wall of worry, Apple is not in that situation. Everybody loves the stock. Everybody's in. That's one of those situations where you hope it doesn't start to go down a little more, break through some technicals, maybe go through 100, because then it slides down that slope of hope, which is the not so good side of that wall.
Yeah, then we leave, and then we got 2 more areas we want to move to, and I'll segue the last part to you. Mm-hmm. Is let's first talk about social media stocks. Cancel culture is back, isn't it? Because now Facebook announced recently that they are postponing. They're actually kicking out and deleting posts. Twitter included. I'm sure Google's going to do the same thing with YouTube, but. Anyone that puts up any kind of political post, right, left, center, whatever, they're going to review it and they're probably going to kick it. And so that is causing a lot of folks to leave social media, especially leaving Facebook. I see a lot of folks leaving Facebook and leaving Twitter and moving to this new social media platform called Parlay. Have you heard of this?
Yes, I have.
And so I don't know if Parlay is going to get going to grow any big wings or not, but they got a good concept out there where they're letting the community vote whether a post should be taken down or not, and not leaving it to what folks are calling the elitists that run the companies.
Yeah, I think this is a great example, or it will be a great example of a social experiment, either gone right or gone wrong. You nailed it. We have to, at some point, be able to say whether we find something offensive or we don't. Some people just want to be informed and they want to get all views. In the case of, in the case of this, we'll see what happens. Man,
And look at
everybody is. Go ahead.
and look at Fox News. Fox News got overtaken by Newsmax
Hmm.
and by One America, because people who were Fox believers just they're scratching their head saying, "What is wrong with this network? They used to be big Trump supporters. Now they're not anymore." And
Yeah.
you know how people are. If you and they do not share the same beliefs, they will leave. And I'm going to give you a great example. So I was years ago. I was at one of those big conferences. I was invited to a big conference where they had breakout sessions, and people would come in the room and listen to me speak, as well as other speakers that were in other parts of the conference center. And I remember this one couple coming in, and I was speaking on risk and reward, and they had their hand raised in the back, and they said, "What do you think about X, Y, Z?" And I said, "Well, I'm really not here to make a determination of whether I like or dislike a particular stock. We're talking about margin of safety and risk and reward." I said, "But you know what? I'll entertain you. Let's put it up on the screen and let's take a look at it." And we looked at it, and it just did not give me any idea of a buy or sell signal. So I said, "I really can't. I can't. I'm not bullish on it. I'm not bearish on it. I don't have the right signals to tell me whether to get bullish or bearish." The couple got up and left. And what I realized is this: they were going around from room to room to room to find some guru, some speaker that agreed with their thought process on that stock. And then they were going to stay for that person's lecture.
Oh my gosh. You know what? I've got to sidebar that thing for a second. I was at a conference up at MIT once, and it was on the psychology of investing. And it was also they were doing lots of financial engineering. They were really trying to answer the question whether technical analysis works or not. So amidst all this, one of the studies they'd done was traders at the Boston Exchange there. And I think it was 6 months or so they had done these studies. And what they found, Tom, was exactly what you just kind of voiced there. They found that traders make a decision, buy, sell, or walk away, make a decision in less than a second. And then they spend the next 10 to 30 seconds rationalizing the decision with the front of their brain. So in other words, their lizard brain. And there's a great book that came out from this. It's Mean Market and Lizard Brains. The lizard brain makes a decision, boom, just like that. And you spend the rest of your time when you're looking at a chart, when you're listening to somebody, trying to rationalize that. And I think a lot of people do exactly what you just said. They'll go and find a guru or an analyst that likes what they like so they can feel good about buying something. That's that trading psychology that's
It
so
is.
interesting and
That
effective.
goes right back to, Chris, and you kind of said it, but I'm going to say it for you. You kind of said it in the last 60 seconds, but
Mm-hmm.
We are our own worst enemies when it comes to trading and investing.
Mm-hmm.
I mean, when you do something wrong, whether it's because you heard somebody on TV talking about it, or maybe you read something on social media, or maybe it was an email, and you made a decision based on those, and you go, and then things don't go your way, whether it's for part of the trade or all of the trade. You have to ask yourself, what did I do wrong? Because most people don't do that. They'll push blame to someone else when they themselves push the buy and sell button. And, and so, yes, we are our own worst enemies. Chris, I want to move to Tesla, because
Yes.
Tesla really starts the conversation that you want to have about clean energy. Tesla is near the top of its Fibonacci range. It is not pulled back. It had a high back just before Labor Day when it had its stock split, and that was up above $500 a share. This is the after split price for those of you that are following along. And now we're sitting back in the low fours. Although what's happened was we went from over $500 a share down to the low threes. And we've created this wedge where the lows have gotten higher and the highs have gotten lower. And you know what? We're sitting right in the middle of a triangle that's going to break one way or another. But you're looking at stocks outside of Tesla and you like what you see. So tell us about it.
I do. I mean, Tesla is the gold standard, if you will, for electronic vehicles, or for all, let's call it alternative, because Tesla's wound up in everything from solar panels to SpaceX to Elon Musk is an amazing person. But Tesla was the first company to go through the door and kind of break through and say, hey, we're going to do this and we're going to make a model out of it that's going to work as a business. Now you've got a lot of companies that are coming up and bringing that exact spirit, whether it's electronic or electric vehicles. Workhorse is a company here in Cincinnati that is manufacturing delivery trucks that are electric. And then you've got NIO in China that just rolled off the 5,000th car in 1 month, a week and a half ago. You've got, and then obviously Nikola, which has been in the news nonstop for the last couple of maybe month and a half because GM came in and said, hey, we're going to do 11%. One of the short covering firms came out and did one of their reports that they do very well. Stock went down, hasn't recovered, had a good earnings report though. My point is that when you look at these companies, Tom, and you and I, not cut our teeth, but certainly we're right in the middle of our careers when we had 2000, 1998, Microsoft, Apple, Intel, Cisco, the four horsemen of the NASDAQ were in full stride. Those have entered into that last phase or that slow, they're all paying dividends now. They're outside of their growth phase. This is the new technology area. I like to call them the new school techs because they simply are at that cutting edge. As we convert to solar, you've got companies like Enphase that are semiconductor companies that also do a lot of work with the solar panels, Genco Solar. And what I've noticed here, there's a end here. We saw a lot of people look at this sector as a whole before the election. And if you were like me, you were saying, well, this is a sector that doesn't matter who's elected president. As I told you before we started talking, I could be living at 1600 Pennsylvania Avenue in January, and these companies are going to go up because this is a new tech movement. And for some reason, they've frozen up over the last couple of weeks, whether it is the idea that we could have, maybe more of a push towards oil and coal. And oil has gone up here over the last few weeks, and coal and natural gas have found a bid. That finally broke free today, and we're seeing a lot of these companies come out of this sleep that we've seen for the last, call it 2 weeks, right before the election. And they are roaring again, Tom. And I think this is going to be one of those year-end trades. If you look at it, whether you look at the ICLN, which is the ETF that covers these, or TAN, which is a solar ETF, or HAIL, HAIL, which is the electronic vehicle. These are the trades that I think you want to look at if you're getting a little aggressive. And I think they're ones that you not only hold till the end of the year, but you also look at 2021 and say, these are the ones that are going to be leaders at the end of the year. Many of these companies are up more than 100, 200% year to date, and they're on everybody's radar. Usually those type of performance numbers come from stocks that people haven't heard of. These are right in the middle of that acceptance phase of a rally, and I think that's going to charge forward and continue to, light up portfolios. You need to balance it out, though. And I tell people,
you do.
I love these new tech names, and I look at Cisco and Intel, and yes, I love a dividend. I love the edge of having a SunPower that'll go up 8, 10, 15% over a week. But at the same time, I want to make sure our listeners don't get out on the edge, get ahead of their skis here. And you really need to balance that out with some safety in your portfolio, whether it's dividend yield, like you said, safety plays, which I think is a great way. You've got some safety plays, right?
Yeah. Well, but you know what? Let me just quickly assess 3 stocks you talked about. Nikola first. Yes. If you look at that as on a technical chart, it looks like it came down for a landing, bounced, and then bounced again. You know how airplanes come down and they hit the runway first, you hear the they chirp the tires, and then they hit again and stick. And that's kind of what Nikola looks like, but it has created a double bottom down here around $17.88.
Yep.
That's the worst looking chart of the bunch. They actually only get better from there. If you take a look at Workhorse, Workhorse was a less than $2 stock back in March and April that went as high. I mean, this thing went above 30.
Yep.
It pulled back. It pulled back to 16. It made a 50% pullback from the lows in March to the highs in September. But now it looks like it's heading back up again as it's now trading up near 20. And then you've got, of the three you talked about, NEO. Okay, so NEO is an exact opposite. This one, as a technical trader, is looking better than anything. You know, Chris, this is amazing. This was a $2.37 stock back in March.
Mm-hmm.
All right, it hit 44 earlier this week. That's a 20 bagger. You don't see those. That's a unicorn.
Yeah, this stock was at, to make that even, and that's impressive. This stock was at $17.82 at Labor Day.
Yeah.
And it's $42. And it is all about, I think it's about a movement towards electric vehicles. And it's also the thing that has put NEO into a different stratosphere over the last 2 weeks is them having, you remember the movie Gung Ho, Tom, with Michael Keaton?
Oh, yeah, yeah.
So remember when they rolled that piece of crap car off of and I think George Wendt or somebody was in the engine compartment. They rolled it off because they were going to prove that they could make X number of cars. Well, NEO just did it, but the car ran. And they had a picture of the factory employees with the 5,000th car that they've made that month. And that is proof of concept. And if you remember, everybody called Tesla out years and years ago. They're never going to be able to make these cars at scale. And now you've got this small company in China that is doing it at scale. And they make a moderate car. They're not making the nice fancy Teslas. Everybody loves to drive the Model S's. They're making a mid-range car that anybody can afford. Yeah.
That's the thing. They don't need to, because Tesla is making cars for, I mean, my neighbor across the street just bought the Y. Or did he buy the E or the 3? Maybe he bought let's see. So I have an S, and I have to keep reminding myself this thing's a $120,000 vehicle. But he's got, Chris, I didn't know until recently that when you add all of their models up, it spells sexy. Did you know that?
Yes. Who was it? Joe Rogan bought him a pair of satin shorts that said sexy across the back of them. And he was trying to get Elon Musk to wear them when they came out with the Y.
Yes. Yeah. So he's got, so my neighbor's got the Y. And even he paid, I want to say with the upgrades and stuff, he was probably in the mid 40s on this thing.
Yeah.
That's more
50.
expensive than most American cars loaded with options on them and decked out. But I mean, there is a movement to go to electric, and all the politicians in the world and all the advocacy groups in the world could push the agenda, but it's really up to the market and people. And one way that this is going to happen quick is if somebody comes out with a car that's a $25,000 car that you can get into, and NEO's got it. And so, I mean, it's going to breed competition. It's going to be great for everybody. But we're talking about safety stocks, and I want to finish up our podcast talking about some safety stocks that I covered recently. So what I was looking for in my core group of safety stocks when I was looking at them, I was trying to find, if I had a scan that I could look at, or let's call it a code that I would follow that had common denominators in them. What I would look for was companies that had a value. That what I mean by that is that their fair value, all right, the actual when you look at all the books on stocks, that the price was actually below fair value, and maybe it paid a dividend. That's great. That's a bonus. But their earnings and revenue increased on average. And, you'd think, well, where are companies like this? Because everything's so overvalued, but they're out there. All right, I'm going to share a couple of them with you here right now. I'm actually going to share 3 of them with you right now.
Here we go.
The first one we'll talk about is Cisco. So Cisco, CSCO, if you take a look and I'm very lucky. I have a Bloomberg terminal, so I'm actually able to go really deep. And I could live to be 150, and I still wouldn't know how to use everything on the Bloomberg terminal because it's just so much of it out there. But when I look at Cisco, for instance, what I find is basically this: their revenue dropped in 2020. Whose didn't? Most companies did not see a revenue increase in 20. They saw a revenue decline. But Cisco is in networking. They are part of the 5G frontier. And what was interesting was even though their revenue declined, their profits still stayed and actually were up a little bit for 2020. Their profits for 2021 look very close to what they see for 2020. Obviously, they've got a great product. And, if you were to summarize, look at their stock price. It's trading at about 40% below the estimate, the basic fundamental estimate of fair value. All right. Their earnings are growing at roughly about 4% a year, and they pay a dividend, and their dividend is greater than 3.7%. So Cisco is on my long-term buy list. And then if I were to move forward, here's another one I want to share with everybody. The home building index has been doing fantastic, and there's companies out there like Lennar, D.R. Horton, Pulte Group that are all doing well. But there's one that actually has total revenue as a percentage that looks even better, and that's KB Homes. The symbol is KBH. So the great thing about KB Homes the best thing is they're in the right sector at the right time. And the reason I mention that is because look at the home building sector. People are right now, in the most part, escaping the cities, and I don't think this is a short-term thing. I think this is a new norm where working from home, we're going to see so much change. People are not going to want to go back into the city because they're going to realize, wow, I lose all that time I'm driving back and forth. That's a cost to me. That's insurance. That's depreciation on an automobile. Mm-hmm. That's gas. That's, my time, and my time is valuable. And a lot of people feel that same way. But if you take a look at KB, all right, so KB is in the right place at the right time. Their PE ratio, just to give you an idea of, their price earnings ratio, is less than 10. When you look at the U.S. market, which is close to 20, so the PE ratio is about half. Their price earnings ratio is half what the market is. They're forecasted to grow. And I don't want to tell you what they grow at this year because it's actually unheard of. But their forecast is to grow over 20% per year. Their earnings grew at nearly 30% this year versus last year. Here's the big things. Builder confidence is up. It's at 85. It's one of the highest numbers that we've seen. After an initial drop, they came roaring right back. Housing starts. Well, they were higher months ago. There was a little drop off, but they've also come back. They're higher too. The biggest industry indicator right now in KB Homes is the 30-year mortgage, which is now sitting above 3%. So like 3.12%, 3.12%. Unheard of. I mean, just fantastic. So that's the second stock I wanted to talk about. And the third, if I were to go through, there's a few other ones I like too, but here's one that kind of hits me a little personally. Thor Industries. Symbol is THO.
Yes.
So when people think of Thor, they think a trucking company, but you know what else they make? They make a big range of RVs. Yep. I own an RV. Well, I like to say I do. I own a van that happens to have places to sleep and a bathroom and a small kitchen in it. So I don't really own an RV. I have a Class B van, all right, a Mercedes Sprinter that my wife made me buy this year so we wouldn't have to stop at rest stops going from Florida to New York and back. And now I'm trying to talk her into making other trips in this vehicle so that at least I can justify the 6-figure cost that came with it. But here's the thing, Chris. Here's another company that's in the right place at the right time. When you look at the RV network or the RV group, which is expected to grow. It's expected over the next 5 years. Thor Industries is expecting over 7% growth, net growth over the next 5 years, which might not sound like much, but you got to remember, these guys were on fire this year in terms of growth. They can't keep up with the demand that's going on in this particular sector. When people think about, Winnebago, or they think about some of the other RVs that are out there, Airstream, these are the high end. All right. And people shake their heads before they buy an Airstream, or people shake their heads before they buy a Winnebago Sprinter van.
Well, you know what, Tom? Even the Forest River, which is the middle of the road, I've got one. They're out of stock, and people, they're hamstrung right now. So you're right. Demand is through the roof
as fast as they can. And they have that mid to lower price range, and they're selling them like hotcakes. And here's the thing, even with their price, and they've pulled back. This stock's pulled back. This was a $120 stock back in July, mid-July. It's trading right around 85 right now, mid-80s, so it has had a pullback. But it's trading at around 18% below its estimate of fair value. And that's after the double from March being at 40. It went from 40 to 120 back to 80, and now it's sitting like right around 85. And their earnings, grew by 66% over last year.
Yeah.
But you know what? And you know this, Chris, the market isn't about what have you done for me. The market's about the perception of what they're going to do next. And, all estimates, this area really is here to stay. Now, when we get a vaccine, there's going to be a lot of vans that are going to come up on the market. And there's going to be a glut of used vehicles. But that will rotate through, within, I would think, a year. And then, and I think that's bumped into this 7.72% of net growth over the next 5 years. But here's the biggest problem that all of these companies I just talked about had. Cisco has this problem. KB has this problem. And Thor Industries has this problem. And the biggest risk to these companies, and it's not a huge one, but it's one that we need to talk about real quick. The biggest risk is high debt. Why do they have higher debt than normal? Because the demand is so high. They're ordering the hardware. They're ordering the raw materials. They're ordering what they need in order to make the products to come close to meeting the demand that's coming in right now. And that's why they've got these higher than normal debts, debt out there that's on the books. But that is built in to all the figures that we have that I shared today. And those are 3 of the stocks that I have as my safety stocks. I have positions, just for disclaimer, for full disclosure, I have positions in each. They are options positions, and options positions that you can take in any of these 3 would be if you could buy the stock, obviously, that's one way to take advantage of any bullish position. You could buy calls, you could buy call spreads, which is cheaper, or you could sell puts, which is not cheaper because that comes with margin, but it does give you a way of getting a premium, and at the same time could allow you to purchase the stock at a set price. So there you go, Chris.
Yeah, there you go. You know what? I got to sidle on your Thor for a second. Camping World Holdings has been one of my favorite companies since March, February.
Gosh.
And
what a great pick.
Yeah, and if you look at the chart of Thor and you look at the chart of Camping World Holding, they are moving lockstep right now. A lot of people look at them and say, "Oh, well, they're trading, below." I always look at the 50-day as my barometer. That is my one thing, my island indicator. They're both trading below 50 days that are trending lower, but everybody is assuming that the rush for the RVs are over. And in this case, it's almost like Zoom. Zoom's not going away, Tom. Regardless of the pandemic, Zoom's not going away. nor is the demand for camping products. Let's throw those two companies out. We've seen a lifestyle change because of this pandemic, and those don't go away just because you get a vaccine. They stick around. You're still going to see people go out camping. We saw this back in the 70s, when people adjusted to gas prices and they didn't want to go on vacation, so they stayed local and they camped, and camping got big and it stuck around. Same thing is going to happen here. So
And
people
this
are
is all early
underestimating the
indicators
longevity.
too,
Yeah.
Chris. I mean, this breakthrough vaccine is still in its early stages. They're saying that if all goes well and they get the approval through the emergency measures, that they'll have 50 million doses out there, 50 million doses out there by the end of the year, which really means, because you have to do a booster shot, that's only good for 25 million people.
Correct.
Well, there's billions of people on the planet. So in order to service all their needs, we're going to probably need at least another year. So this is going to be stuck with us for another year, which means another year of planning, another year of mask wearing. By the way, I don't think the mask is going away anytime soon. I feel weird not wearing a mask in public now. How weird is that?
I'm with you. You know what? I'm getting ready to get on a plane to go to Baltimore tomorrow morning. And I washed all my masks, and I realized I've got this process now of washing the masks, a couple times a week. And I said to myself, this is here to stay. It's,
amazing.
I like having, I've got a mask in each vehicle. I've got a mask on my boats. I've got a mask in my camper. You're right. I don't like not wearing it anymore. So
yeah,
it's here for a while. We're not done with this yet.
Well, Chris, thank you for joining me again on this week's edition of our Profit Strategies podcast. Have a safe travel to B-Town, and have a great rest of your weekend. Guys, thanks for joining me. We will be at it again next week, all new topics. And until then, have yourselves a great weekend. We'll see you next week. Bye now.